as investors grapple with the wide-reaching implications of tariffs, markets now face another risk. Tensions have also been escalating between the U.S. president and the country's central bank chief. Now, Mr. Trump has suggested that he could kick out Federal Reserve Chair Jerome Powell for refusing to aggressively cut interest rates. But such a move could threaten the U.S. central bank's independence, which has long been supported by economists and investors because it can more easily take on necessary but unpopular measures to fight inflation. Well, the central bank chief clapped back, saying the president cannot remove him except for cause. Most scholars agree that Mr. Trump can't fire Mr. Powell from the Fed's Board of Governors, but questions remain over whether the president can remove him as chair. Now, any move to do so by Mr. Trump will likely end up at the Supreme Court. Now, Chicago Fed President Austin Goolsbee has warned against efforts to curtail the bank's independence. He said in an interview with CBS's Face the Nation that in countries where central banks don't have such independence, inflation is higher, growth is slower, and the job market is worse. Well, Itay Goldstein, professor of finance and economics and chairperson of finance at the Wharton School, University of Pennsylvania, joins us for more now. So, Professor, it's just questions really about the independence of the Federal Reserve, and that is adding, another layer to the volatility that markets are already struggling with. How key, first of all, is independence and stability in the Fed, especially right now?
Hi, it's great to be with you. So independence of the Federal Reserve, independence of central banks is absolutely crucial. There are many debates in economics on many issues, and I think this is one of the issues on which, even if we don't have full consensus, we probably have something that is close to consensus. Once the central bank, and in this case, the Federal Reserve, loses its independence, then basically we cannot count on monetary policy to do the right thing. And this can be very bad for the economy. If you think about governments, definitely have the temptation to reduce rates, and this can cause inflation. This is bad for the economy in the long run. And once we have the independence of the central bank, we can count on the central bank not to fall into this temptation and to do the right thing. Which, even if it is more painful in the short run, it will benefit the economy in the long run.
Right. I guess, the question is really how independent is the Fed supposed to be? I mean, what are its roles and responsibilities? And can Congress change the law?
Right. So, when you think about the roles of the Federal Reserve, it starts from monetary policy. They set the interest rate, they control the supply of money. With this, they basically try to achieve the mandate of certain rate of inflation and also maintain a low unemployment. So this is basically what the Fed is trying to do with its monetary policy. Of course, beyond that, the Fed is doing other things. The Fed is responsible for financial stability, supervising the banking system, looking at other parts of the financial system, addressing financial crisis, and so on. With regard to the monetary policy, I think, as I mentioned before, there is a wide consensus that the Fed should be independent. When it comes to the other roles of the Fed, if you're thinking about, say, bank supervision, I think on this it is less clear-cut. When you ask whether the Congress can do something to amend this status quo, the answer is probably yes. There are certain things that they can do to make the Fed less independent.
Yeah, and I also want to know, about the power of the president. I mean, can he perhaps override congressional safeguards to oust Jerome Powell before his term ends in May 2026? I mean, last week we heard Donald Trump saying that if he wanted Jerome Powell to be out, he could do that. And very quickly, of course. And what is the likelihood that Trump could do that versus letting Jerome Powell just complete his term? In the meantime, kind of work to reshape the Fed in other ways. I mean, what would work better for the president in this instance, if you could even put it that way?
Right. So if you're thinking about whether the president can fire the chairman of the Federal Reserve, there are probably ways by which he can try to do that. It will certainly be an uphill battle, and it will certainly end up in the Supreme Court. And I would guess that it will not go through. But, once we go on this path, then there are probably different outcomes that could happen at the end. When you're asking whether this would be a wise thing to do, I would say no, it's not. Even before we come to the realization of how far we go down this path and what the courts will say and how it's all going to end up, the response of the market is probably going to be catastrophic in an event like this. Because as I mentioned before, one of the things that most economists would agree on is the importance of the independence of the central bank. And if there is a threat to the independence of the central bank in a place like the United States with all its history, then markets are going to conclude from that economic conditions going forward are not going to be like we were used to in the past. And as a result, the response of the market is probably going to be very negative. Now, we saw that in past events, the president did announce certain policy steps. The market did not react very positively, reacted, in fact, very negatively in some cases. And this did not detail certain actions, but we do see that in the end of the day, the market does have power over the administration in the sense that when there is clear indication that something is going to lead to a very bad outcome, to an economic crisis, then they're probably taking a step back. So I would assume they're not going to go down that path. I don't really see what benefit there is in doing that, and I just think it is going to throw everything into chaos.
Professor, on the need for policy easing, I mean, this is not new. Donald Trump has repeatedly called for the Fed to lower interest rates. And then he's attacked Jerome Powell for not doing so, or being slow to do so, and saying that, he should take a leaf out of the ECB's book and ease on rates as well. I mean, looking from, the president's perspective, is there perhaps some benefit to stimulating the economy at this point?
Well, there is always this tension between what the government wants and the way that the central bank or the Federal Reserve is going to look at this. So there is always a short-term benefit from stimulating the economy. The problem is often with the long-term cost of doing that. With everything else that is going on in the background, with tariffs that are putting pressure on prices and inflation, I think the calculation of the Fed in this case was that it is probably not the right thing to do at the moment to reduce rates. When we were coming out of the COVID-19 crisis, they were probably not aggressive enough in keeping rates up to fight inflation. And at the end of the day, we did see inflation picking up probably beyond expectation. And this did hurt the economy in the long run and probably cost the Democrats the election to a large extent. So there is always this temptation to stimulate the economy in the short run, and there's certainly a lot to say for that. However, if you always follow this temptation and you don't maintain this long-term discipline and long-term stability, overall, the consequences are worse. And this is why it is so important to maintain this independence of the central bank and have this separation of power.
All right, Professor, really appreciate your insights. Itay Goldstein there, Professor of Finance and Economics and Chairperson Finance at the Wharton School, the University of Pennsylvania.